Inflation is rising. Everyone is predicting a crash in the stock market. But is it possible to invest right now and still make money? Well, the answer is yes. That's why I prepared 5 ETFs that you should invest in right now that are going to stay recession-proof in 2025 and are going to make you a lot of money. Even in the toughest times, people still need to brush their teeth, look after their houses, and take care of their health. That's why there's sectors that historically have shown great resilience during economic slumps. These defensive sectors include healthcare, utilities, consumer staples, and certain technology companies. That's why I'm going to be talking about ETFs that fall into this category. And also I chose a metric to compare how the ETF performs relative to the stock market, which is a beta. A high beta means that the ETF is performing similarly to the stock market. So if the stock market goes really high up, the same is going to be happening to the ETF. However, this goes also the other way around. If there's a market crush, then our ETF is going down too. So let's jump right in. The first ETF I'm going to be talking about in this video is the VDC, which is the Vanguard Consumer Staples ETF. The portfolio is composed in 30% of consumer staples merchandise, 18% in household products, and 16% in soft drinks and beverages. The main holdings of this ETF include Costco, Walmart, and Procter & Gamble. These companies have cultivated a very strong consumer loyalty over the years, which is really good for us. It means that shoppers are less likely to switch even if they are on a tighter budget. Over the past decade, the Vanguard Consumer Staples ETF has delivered an average annual return of approximately 8.17%. It has also shown incredible resilience to the market during market crashes. The VDC ETF also gives a 2.19% dividend yield, which means that if you invest $1,000 into it, it gives you back $22 per year. The ETF also has a 0.6 beta, which means that it's not very volatile compared to the market. VDC stands out as a great option. It has very high dividend yields and also consistent growth despite market crashes. If you invested in 2015 $1,000, today your position would be worth around $2,193. It is also worth noting that VDC is a pretty cheap option. It has an expense ratio of 0.09%. What it means is that every $1,000 invested in this ETF incurs an annual fee of only 90 cents. So, if you're looking for stable dividends and reliable growth, VDC is definitely a great option to consider. The next ETF we're going to be talking about is the iShares US Healthcare Providers ETF, for short IHF. People need medical care regardless of economic conditions. This ETF focuses on companies that manage and provide healthcare services, like United Health Group and Cigna Corp. Since people still keep their healthcare insurance despite economic downturns, those companies always see stable revenue streams. On top of that, with the aging population of baby boomers, the demand for healthcare services is only expected to increase in the coming years, making IHF such a strong long-term investment. Over the past decade, IHF has averaged an annual return of 7.89%. However, over the past 3 years, it has experienced some downturns. The ETF also provides a dividend yield of around 0.8%, which means that for every $1,000 invested, you received $8. It is also worth mentioning that it has a beta of around 0.67. If you invested $1,000 in this ETF in 2015, your position today would be worth $2,130. It is also worth mentioning that the expense ratio of this ETF is 0.4%, which means that for every $1,000 invested, you pay a fee of $4. Next ETF we're going to be talking about is the Vanguard Dividend Appreciation ETF, for short VIG. The Vanguard Dividend Appreciation ETF, as you probably guessed by now, focuses on stocks that are heavy in dividends. This ETF is a collection of the market's most reliable dividend payers, companies that have not just paid their dividends, but increased them for the last 10 years straight. They tend to be established companies with strong financial foundations and steady cash flow, like Microsoft, Apple, and Broadcom. What's super interesting about this ETF is that a lot of the companies that this ETF holds are considered dividend aristocrats. What this means is that those companies for the last 25 years have increased continuously their dividends. This track record is super impressive, but it also shows us as investors that we can expect steady dividend increases. Other than Apple and Microsoft, this ETF also holds Visa and JP Morgan as a big chunk of their portfolio. VIG has shown an average annual return of around 11.21% over the last 10 years, and the current dividend yield is around 1.80%. Also, the expense ratio on VIG is very cheap, only around 0.06%, which means that if you invest $1,000, you're going to pay only a 60-cent fee. This ETF is a great option for anyone seeking a defensive position that is also going to give a steady cash flow every quarter, which it pays out dividends. Now we're going to talk about the utility sector, particularly the utility sector SPDR ETF, XLU for short. Utilities are as recession resistant as it gets. People simply need electricity, water, and gas. This ETF tracks the Utility Select Sector Index, which means for us that it invests in companies that provide essential services, such as Nexta Energy, the Southern Company, and Duke Energy Corp. XLU offers investors a piece of this steady and reliable sector. And since utilities operate within regulated monopolies, they typically have a very predictable revenue stream. So even though utilities are not going to provide crazy returns during the good times, they're going to show great resilience during bad times and will offer dividends. The XLU has a beta of 0.78, which means that it has a higher correlation with the market compared to, for example, VDC or IHF, yet it still is much more resilient to any changes. In the last 10 years, XLU showed an average annual return of around 9.49%, with a dividend yield of 3.19%. It has an expense ratio of only 0.08%, which means that for every $1,000 invested, you pay a fee of around 80 cents. Now, who's hungry for some money? This list would not be complete without a food and beverages ETF. Everyone eats, regardless of economic conditions. This ETF tracks the dynamic food and beverage Intellidex index, which means that it focuses on companies that produce, distribute, and sell food and beverages, typically the essentials for any grocery list. Keep in mind that during a recession, people eat less outside, yet they still have to buy groceries. From the most recognized names, this ETF holds companies such as Kraft Heinz, Coca-Cola, and Dr. Pepper, which typically maintain a relative stable sales even as consumers switch to cheaper brands. They also tend to pay solid dividends, with PBJ paying 1.18%. Over the past 10 years, the average annual return for PBJ was 5.01%, showing steady growth, and with a beta of 0.66, it showed a lot less volatility than the market itself. Having invested $1,000 in PBJ 10 years ago, your position would be worth today around $1,700. Because of the higher dividend yield, you're gonna have to pay a higher expense ratio of around 0.6%, which means that $1,000 invested is a $6 annual fee. Remember, investing during economic uncertainty does not have to be stressful. If you focus on recession-resistant ETFs, you can safeguard your money while still earning very solid returns. If you want stability and strong dividends, VDC and XLU are going to be great options. However, if you prefer more steady growth and healthcare resilience, I would suggest IHF. Lastly, when it comes to consistent dividend growth, VIG is a very easy choice. No matter which ETF you choose, remember to invest long-term, stay diversified, and stay smart about your portfolio. Let me know in the comments which ETF you ended up choosing. See you.